Hi, and welcome to the Everyone Funding Startups podcast. This week, I'm your host, Paul Higgins, and I'm joined by Boaz Vinagradov, Managing Director of Navocate, which provides business sales and acquisition services for entrepreneurial companies. Before getting involved with Navocate, Boaz was president of CardGuard, an Israeli medical device startup that went public on the Swiss Stock Exchange, president of Nova Inc., and vice president of NASDAQ-listed Nova Measuring Instruments, and also managing partner of iFinancial, raising capital for high-tech startups and venture capital funds. And he also co-authored and sold 3 internet patents. Boaz, welcome, and thanks very much for joining us.
Thanks for having me.
There's really so much we could talk about with your background, and today I'd really love to ask you about valuations, startup valuations. It's one of the most common questions we hear from entrepreneurs looking at crowdfunding and raising capital in general. You know, how do I value my startup? How much equity should I be giving away? Could you start us off and telling us a little bit about the main principles behind valuing emerging companies and perhaps how they differ from valuing more kind of traditional publicly listed corporates?
Sure. There are several basic methods that always apply because business is a for-profit kind of a thing. So people are looking to see what the returns are going to be. Not that many of us don't enjoy the startup environment, whether it's my experiences in technology and the creation of something that wasn't there before in terms of applying technology to a practical solution. But startups are restaurants, small businesses, service businesses, you name it. It starts with a startup, and innovation, as we know, it starts with the smaller groups because they are more effective and more efficient based on cost because they don't have much of an overhead to address and don't play by the rules or don't have to play by the organization rules. And as a result, oftentimes you see the large players, pharma, Google, Cisco, Intel. You look at the number of startup companies they buy every year, and it's measured in tens. Google got to 59 in 2011. But that represents the smaller group of technology companies. We're hoping that the larger group would be Main Street businesses of any type that will have the ability to access capital in a different manner than is usually not available to them today. So the valuation methods are pretty much the same. There are 3 ways to look at things. You look at the historic performance, which most startups do not have. And, if you sold $10 million last year, I can say, well, there's a proof that this business really works. And so I look at your profit or I look at your revenues and I apply a multiple for it. I look at databases that provide me data of other companies that sold with a similar product in a similar marketplace and what prices that did they fetch. And so that's sort of a historic market value approach, whether you are using in the US EBITDA multiple and in some in most other places another profit multiple or revenue multiple, depending on industry. The second way to look at it is to look at the future and say, okay, if I put $1 in this company today, what will I get over the next 5 years? And you do an ROI, a net present value, or a discounted cash flow. All of them are methods that apply different level of risks by changing the interest rate in which you discount the expectations. Now, so that's the second major way of looking, which is forward-looking. The third way is most usable when you're trying to replace Give you an example. Strategic buyer looks at an opportunity of getting into a new market. They can start their own R&D project. It'll take 2 years to bring a product or a service to market and fashion it the way customer wants, or they can buy an existing company, sometimes not profitable, sometimes without revenue at all, that have made some of the strides and saved time and connected or potentially connected already with customers, and now it's a replacement cost. And so you're saying to do it internally will take 2 years and cost X amount of dollars. To replace it by buying from the outside will cost so much less and will take that much less time. And the calculation of both of those leads you to present a price and propose to buy. The last way is rarely used anymore, and it's more for taxation, and that's book value. You go to balance sheet and figure out the shareholder real net value of over there. But this is really more of a taxation purposes because, again, startups don't really have a balance sheet that is established and significant enough. So those are the ways of generally analyzing value. And I suspect that with startups, you want to focus on the forward-looking because your past financials don't really contribute much. The difference over here between a public company and a non-public company was very apparent with Facebook. If you look at it, when Facebook went public, the discounting factor that JP Morgan assigned to it was 6 to 8%. And so there's some range, which is something that is important to mention. There is a range of prices that JP Morgan felt that will be a good reflection of the risk of the company. Now, as it went public, the price went down. And if you figure it out again and you look at 3 weeks after they went public, JP Morgan presented a new analysis that showed that the discounting rate used is somewhere between 10.5% and 11.5%, which obviously reduced the value of the company because as you discount future earnings to a present value, you get less of a value. Now, is this rates that we can use for our startups? I think not, because Facebook still had several billions of dollars in revenue and close to 1 billion users. If you have a similar number, yes, you can use a similar rate. But typically, I think that numbers between 15, 18% discounting would be the lowest, and 20 to 25 and even more would be more likely. We see, again, depending on the risk level and the type of industry you're walking into, range around somewhere between 18 and up to 33%. I have not seen anybody doing over 33%, but if you are day one of a new Twitter or Zenega or others, you certainly see a discounting rate of 33%.
Okay. And talking about Facebook, I think that another interesting case might be the Instagram acquisition. They I don't know what their revenues were when they were acquired, but I don't think it would be based on historic revenues at least. Do you think that was based on the forward-looking methodology, or is it more the kind of looking at their alternatives, Facebook alternatives, looking at kind of where the value would be in the acquisition?
Well, I think that time to market was the main driver over here, not cost. Facebook, like any other conglomerate, and at this point they are a conglomerate, just by way of having 1 billion users and close to, I believe now the number is 70,000 advertisers above above